everyone, I'm Dongling. Today we are going to talk about the audit risk model, and I will take Frontera Cooperative Group Limited as an example. First of all, let me introduce Frontera. Frontera is a global dairy nutrition company. Their products including liquid milk, milk powder, cream, cheese, and so on, and it is also a listed company. So why is Frontera audit? Well, New Zealand regulation require that all the FMC reporting entity, including listed company, to be audited. Furthermore, refer to the agency theory. When the principal get the manager of Frontera to work on their behalf, there is a separation of ownership and control of Frontera, and there is information asymmetry between two parties. Because manager is involved more in daily operation, therefore, an independent audit could effectively reduce the chance of manager manipulating the financial report. For example, increasing earning to earn bonus. Independent audit will increase credibility and quality of a financial report. For example, the bank should refer to financial statement to consider whether Frontera will able to pay back the money in the future to decide whether to lend money to Frontera or not. If Frontera has an outstanding performance, the bank may consider reduce the interest rate, so Frontera can reduce the cost of capital. An investor need financial statement to help them consider the profitability of Frontera to decide whether they invest it or not. Inherent risk does Frontera face? Inherent risk is the chance of misstatement in an assertion if no relate control prevented. The auditor is not able to control the level of inherent risk. An example of inherent risk is, as we can see from their financial position as of July 2022, Frontera has 2,119 million owing to supplier under their current liability. However, their net cash flow from operating activity is only $193 million. Frontera will capitalize intangible assets such as software assets if there is an indication that intangible assets will generate future economic benefit. There is an inherent risk because, first of all, intangible assets value is only an estimate. Intangible assets value cannot be directly observed, which require professional judgment. An indication of future benefit may be subjective. Also, another inherent risk is because Frontera has a subsidiary in Sri Lanka, and under the influence of the substantial depreciation of the rupee this year, their foreign currency payable is more expensive for Sri Lanka subsidiary. So there is an $80 million adverse revaluation of the co-op's Sri Lanka business payable. Frontera also face control risk. Control risk is the chance that a material misstatement could occur in the assertion and not be prevented or detected by the entity internal control structure. And the auditor is not able to control the level of control risk as well. Frontera work with more than 10,000 local farmers in New Zealand who are Frontera's dairy supplier. Since Frontera has many suppliers, if the process of choosing the supplier is not transparent, Frontera will face control risk. Because if the supplier is fictitious, Frontera will increase the owing to the non-existent inventory to the fictitious supplier. Also, there will be control risks if Frontera is not regularly reviewed on impairment or capitalization of intangible assets, because impairment or capitalization of an intangible asset could be pretty subjective sometimes. More review is needed. The last control risk is because Frontera has business all over the world, and they are dealing with many cash. If their local branches do not timely reconcile with the bank, they may face the risk of that employee can easily steal cash. What about detection risk? Detection risk is the risk that an auditor will not detect any material misstatement that exists in an assertion, and the auditor can control the detection risk level. Also, it is an inverse relationship between material misstatement, which is inherent risk plus control risk and detection risk. So if we look at Frontera overall, I think Frontera has a higher inherent risk because the size is very large. Moreover, they have lower control risk because they have more regulation and relatively mature internal control. Therefore, they can have a medium detection risk. Also, since the control risk is the lower level, they can perform testing the process on medium sample size. That's all I have for today. Thank you for listening.